Okay, dear students, let's just start a very first class of crash course of taxation and finance act, which we'll be doing right now. It is FA 2025. Okay, so finance act 2025. Let's start the crash course. Just a minute. What will be the sequence? Each and everything I'll explain. We are actually starting from individuals and then slowly and gradually we'll go for corporation tax. In individuals, okay, these are the tax rates, students. All these tax rates, everything will be given to you in exam. When it comes to individuals, you can see these are the tax rates and they will be actually given to you in exams. Okay, so let's start. A very first question, and I want everyone to participate in that. We are starting from income tax calculation for individuals. Let's say we have Mr. Y. Mr. Y is having employment income of £40,000. Saving income means interest income. He's having interest income of £10,000. He's also having dividend income of, let's say, £15,000. He's also having a pay as you earn, let's say £5,000. Required, number one is income tax liability and the second is tax payable. Pay means pay as you earn. So pay is the tax which individual has paid in advance. Normally what happens when you are working for someone as an employee, so then what happens, normally you will be paying tax in advance. When you will be getting your salary, logically you will get your salary after the deduction of tax, and that is pay as you earn. Another point, employment income is a non-saving income. Another example of, let me give you few examples of non-saving income, because first we have to apply the tax rate on non-saving income. So what are the examples of non-saving income? Employment income, for example, is a non-saving income. Property income, trading income, income which is coming from the partnership. Even the pension income also is considered as a non-saving income. So whenever we are required to calculate income tax liability, you have to make three columns. One is for the non-saving income. Second column is for the saving income. Third column is for dividend income. And the last one is total. Students, saving income means interest income. Saving income means interest income. If the interest is coming from individual saving account, we know that the interest income which comes from individual saving account, it is exempt. So if you are having interest income from individual saving account, it will be mentioned in the question. If nothing is mentioned, just saving income is given. So it means that saving income is a taxable income. It is not an exempt income. Okay. I'm directly writing this. Employment income is a non-saving income, 40,000. Saving income is 10,000. Dividend income is 15,000. So we'll take the total, that is 50 plus 15, 65,000. Personal allowance. The normal sequence of personal allowance is, first personal allowance is deducted from the non-saving income. Sounds issue? Am I audible to everyone properly? Kindly reply, please. One student is having, I think, sound issue. Quickly reply. Am I properly audible to everyone? I am audible. So please, you check on your side. If you're having sound issue, you can rejoin us. The normal sequence of utilizing the personal allowances. First, we deduct the personal allowance for non-saving income. If I don't have non-saving income, I'll go for saving. Even I don't have saving, then I'll go for dividend income. That's a normal sequence of utilizing the personal allowance. Personal allowance is 12,570. Here comes the taxable income. 40,000 minus 12,570. It is 27,430. Okay. Then I've got 10,000 and 15,000. Final answer is 52,430. Income tax. Obviously, first we have to apply income tax rate on non-saving income. An entire 27,430 actually falls in basic rate band. So 27,430 non-saving income. Applicable rate is 20%. So 27,430, let's take 20% of this. I'm getting 5,486. Okay, now kindly listen to me quickly. Concept number one, when it comes to saving income, if individual is a basic rate taxpayer, that individual gets nil rate band for the saving income of £1,000. Second, if individual is a high rate taxpayer, that individual gets nil rate band of £500 for the saving income. And finally, if someone is an additional rate taxpayer does not get any nil rate band for the saving income. Okay. So right now, how do we decide individual is a basic, higher, or additional rate taxpayer? By looking at the final total taxable income. Total taxable income of this individual is 52,430, which is more than the basic rate band. So this individual is a higher rate taxpayer. Whoever is a higher rate taxpayer gets nil rate band £500 for the saving income. So saving nil rate band. Saving nil rate band is 500 into 0%. I have given the reason why it is 500. Now, student, we have to see how much space do we have in the basic rate band. Basic rate band limit is 37,700. We have utilized 27,430. We have also utilized 500. Let's see how much space we still have in the basic rate band. Wow, we still have 9770 in the basic rate band. Now, please look at this. Taxable income, when it comes to the column of saving income, we have got 10,000. Out of 10, 500 we have already taken in nil rate band. So we still have 9,500 from the saving income. And entire 9,500 of the saving income falls in basic rate band because we still have a space in basic rate band. We still have a space in the basic rate band 9770. And our saving income is only 9,500 and applicable rate is 20%. 9,500, let's take 20% of this, I'm getting 1,900. Now we'll go for dividend income. Now listen to me carefully, students. Every individual means every individual, irrespective of their tax paying status. Irrespective means someone could be a basic or a higher or even an additional taxpayer. Every individual gets nil rate band of £500 for their dividend. So dividend nil rate band 500 into 0% is obviously 0. Now the question is, what about the remaining 14,500 from the dividend income? Now listen to me carefully. Do we have any space in the basic rate band? Actually, we do not have any space in the basic rate band. How? Look at this. There was a time when we had 9770 in the basic rate band. 9,500 we have utilized here. Obviously, this 500. If I deduct 9,500 from 9770, I only have 270. So logically, the dividend nil rate band utilizes this remaining 270 as well. So now we do not have any space in the basic rate band. So the entire remaining dividend income, which is 14,500, falls in higher rate band. And in case of higher rate band, dividend income applicable rate is 33.75%. So dividend income 14,500 into 33.75%. 14,500 into 33.75. Students, I'm getting 4,893.7, so make it 94. Let's add all of them. 5,486 plus 1,900 plus 4,894. Students, I'm getting 12,280. Kindly, I want at least 2 or 3 students. They should also check. This is income tax liability. This is your income tax liability. But the problem is this individual has already paid a 5,000 tax in advance. This individual has already paid a 5,000 tax in advance, so we'll deduct the pay. Pay means pay as you earn. Simply the tax which individual has paid in advance. So how much still this individual will have to pay? Can I say 7,280? This is your income tax payable. Student, this is your income tax payable, which is 7,280. Okay. Let's say we have employment income 10,000 pound. We are having saving income, let's say 20,000 pound. We are having dividend income, let's say 25,000 pound. Required is income tax liability. Students, I'm giving 5 minutes. Each one of you is having 5 minutes. I want everyone to attempt this. Kindly, everyone should attempt this. You have 5 minutes to attempt, please. Okay, students, let's do it together. Again, we'll be making 4 columns. Non-saving income, okay. You are not supposed to use these shortcuts, okay. You have to properly write non-saving income. Then saving income, dividend income, and total. We know that employment income is a non-saving income, which is 10,000 pound. Saving income is 20. Dividend income is 25. So 45, 10, 55, if I'm not wrong. Personal allowance is 12,570, but I'll be using 10,000 here. And the remaining personal allowance, can I say, students, we'll use here 2,570. Okay, here comes the taxable income. 20,000 minus 2,570. I'm getting 17,430. 25. Wow, the things are interesting. I'm getting 42,430. Now, students, listen and listen to me carefully. In the column of non-saving, the taxable income is 0, which means that when you will be applying tax rate on the saving income, the entire basic rate band of 5,000 is available to you. Now, let us spend around 2 to 3 minutes when the basic rate band is available and how much it is available. When starting rate band, when the starting rate band is available and when it is available and how much it is available. Look at this. You need to focus on the column of non-saving income. I have deducted the personal allowance. Here I am writing starting rate band. Now kindly focus. Scenario number 1, let's say the taxable income in the column of non-saving after deducting the personal allowance, it is 0. If taxable income in the column of non-saving after deducting the personal allowance, it is 0, you will get the starting rate band 5,000 for the saving income. Second possibility, If taxable income in the column of non-saving after deducting the personal allowance, let's say it is 2000. If it is 2000, then you will be getting a starting rate band 3000 for the saving income. Third, assuming taxable income in the column of non-saving after deducting the personal allowance, it is 4000. If it is 4, logically on this 4 I'll apply 20%, here I'll apply 20%, here I'll apply 0%, here I will apply 0%. If it is 4000, then I'll get a starting rate band of 1000. I'll apply 0%. Fourth situation, assuming that taxable income in the column of non-saving after deducting the personal allowance, it is, let's say, 4500. On this 4500, I'll apply 5% or 20%. I will get a starting rate band of 500. I'll apply 0%. If I'm getting taxable income in the column of non-saving equal to greater than 5000, if I'm getting taxable income in the column of non-saving equal to greater than 5000, then we will not get any starting rate band. So why starting rate band was not available in the previous question? Look at this. In the previous question, the taxable income in the column of non-saving is far more than 5000. The concept is, the rule is, whenever you are having a taxable income in the column of non-saving 5000 or more, you will not get starting rate band for the saving income. So here you will be getting a starting rate band. Entire 5000 is available starting rate band for the saving income. 5000 into 0% is obviously 0. Now the next question. Now we have to check what is the individual's tax paying status, because we know that if individual is a basic rate taxpayer, then that individual gets nil rate band 1000 pound for the saving income. If individual is a higher rate taxpayer, then that individual gets nil rate band 500 pound for the saving income, and someone is an additional rate taxpayer, then that individual does not get any nil rate band for the saving income. And how do we decide the taxpayer's status? By looking at the total taxable income. Student, look at this. This individual's total taxable income is more than the basic rate band. So this individual is a higher rate taxpayer. Whoever is a higher rate taxpayer gets nil rate band 500 pound for the saving income. So saving nil rate band. Saving nil rate band 500 pound. And let me tell you one more thing. Some of the students, they make mistake in one thing. They just keep thinking that we do have a space in the basic rate band, so why we are not taking 1000? Listen to me. Individual will get nil rate band 1000 or 500. It does not depend how much space we have in the basic rate band. It actually depends on the individual's tax paying status. And how do we decide individual's tax paying status? It is always decided on the basis of total taxable income. So here the individual is having total taxable income more than the basic rate band. So this individual is a higher rate taxpayer. That is why getting a nil rate band of 500 pounds. So obviously the remaining saving income falls in basic rate band. So from 17,430 we'll deduct 5,000, we'll deduct 500 as well. Let's see how much is left. 17,430 minus 5,000 minus 500. I'm getting 11,930. Applicable rate is 20%. 2,386. When it comes to dividend income, everyone knows that every individual gets dividend nil rate band of 500 pound irrespective of their tax paying status. Now students, we have to see how much space we have in the basic rate band. We know that basic rate band is 37,700. We have utilized first 5,000, then we use 500, then we use 11,930, then we further use 500. So let's see how much space we have in the basic rate band. 37,700 minus 5,000 minus 500 minus 11,930 minus 500. Students, I'm getting 19,770. So we still have a space in the basic rate band, 19,770. So dividend income, 19,770. Applicable rate is 8.75%. Students, I am getting 1729.8, so make it 1730. Now the remaining dividend income obviously falls in high rate band. Total dividend income, we are having 25,000. We have utilized 500 and also 19770. Now we do not have any space in the basic rate band. So 25,000 minus 500 minus 19770. I'm getting 4730. Logically, 4730 falls in high rate band. Applicable rate is 33.75%. I'm getting 1596. So here comes your income tax liability 2386 plus 1730 plus 1596. Students, I'm getting income tax liability 5712. So why some of the students they were having different results? So students, income tax liability is 5712. I strongly believe this calculation should be clear to everyone. And hardly just we had one answer. That was also not matching. Okay, let's go ahead. Now, students, listen and listen carefully. There is one concept, and the name of the concept is personal pension scheme. Okay, before that, let's see. Any question we are having? Dividend income was not 55,000. It was 25. Okay, now come here, students. Look at this, the concept of adjusted net income. How do we calculate A&I? First, the net income minus the gross gift rate donation. How do we gross? We'll see 100 upon 80 gross personal pension contribution. Then you will get adjusted net income. A very important concept is if your adjusted net income is more than 100,000 pounds, then your personal allowance will reduce. If your adjusted net income is equal to 1 lakh or less than that, then you will get the entire personal allowance. So it means those individuals, they are having adjusted net income less than equal to 1 lakh pound. All these individuals will get the personal allowance 12,570. But if someone is having adjusted net income, I would say more than equal to 1,25,140, that individual will get personal allowance 0. So basically, net income, from net income we deduct gross gift, aid, donation. Nothing is mentioned, only the question says someone has paid the gift aid donation. We will always treat that 80% and you have to make it gross by multiplying by 100 and divide by 80. No, right now, kindly, you are not supposed to use microphone. At the end, you can use. So gross gift aid donation. Gross gift aid donation. If nothing is mentioned, whatever donation is given, we will always assume it is 80%. It is 80% and you have to gross it up. Multiply that by 100 divided by 80. Second, gross personal pension contribution. Gross personal pension contribution, again, nothing is mentioned. We will always treat that given personal pension contribution is 80%, you have to gross it up. You need to multiply that with 100 upon 80. You will get ANI. But main concept is if adjusted net income is less than equal to 1 lakh, the entire personal allowance is available. If someone is having adjusted net income equal to greater than 125,140, personal allowance becomes 0. What is the formula? The personal allowance is 12,570 less ANI minus 1 lakh, take 50% and deduct. Assuming, let's say, Mr. Y is having employment income. Mr. Y is having employment income of 1,50,000. And let's say personal pension contribution. Personal pension contribution. Let's say the personal pension contribution, just give me a minute, please. Personal pension contribution is 35,000. I have just mentioned, if examiners, if nothing is mentioned in the question, personal pension is always treated as 80%. It is always net. You have to make it gross. Required is personal allowance for Mr. Y. How much personal allowance Mr. Y will get? Kindly, I want every one of you to calculate. Meanwhile, I'll answer the queries if there is any question. There's a question, sir, does interest income include all the income earned from the interest? Should the income earned from money deposit in ISA? I think I've already mentioned one thing. If individual is getting interest income from individual saving account, so that is a interest income as well, but it is exempt. Exempt means you are not paying any tax on that. So whatever income is coming from ISA, individual saving account, if your examiner says from ISA, individual has received the interest income, yes, it is an interest income, but it is exempt. You are not paying any tax. If the examiner says individual has received the dividend income from ISA, from individual saving account, yes, that dividend income is a dividend income, but it is exempt. And it is not necessary in ISA, you have to keep the cash. In ISA account, you can keep even shares. Is that clear? So from ISA account, from individual saving account, either the interest income comes, it is exempt. If dividend income comes, it is exempt. If you are selling those shares, they are in ISA account. So the capital gain on those shares is also exempt. So it's a very simple rule. Whatever comes from ISA, interest income, dividend income, capital gain, all are exempt. So I hope I have answered this query as well now. Kindly, I want every one of you, give me the answer how much personal allowance Mr. Y will get. Okay, so let's try. Net income is 1,50,000. We will deduct the gross PPC. 35,100 upon 80. 35,100 upon 80. I'm getting 43750 minus 1,50,000. So adjusted net income is more than 1 lakh. Okay. Personal allowance is 12,570. 106,250 minus 1 lakh. We'll take 50% of this. So 6,250. 9,445. Let's see what about others. Everyone is getting the same result. That's nice. Okay. Now, student, listen and listen carefully. When it comes to gross gift, aid, donation, and gross personal pension contribution, whatever individual pays, it is treated as 80%. Whatever individual pays, it is treated as 80%. Logically, 20% will be paid by HMRC. So whatever individual pays, it is treated as 80%. 20% is paid by HMRC. Second, basic rate band. We know that basic rate band is 37,700. Logically, due to gross gifted donation and gross personal pension contribution, your basic rate and higher rate band will increase. Gross gift aid donation plus gross personal pension contribution. They will increase your basic rate band and they will increase your higher rate band as well. 125140 gross gift aid donation plus gross personal pension contribution. So point number one, whatever individual has paid, it is treated as 80%, 20% is paid by HMRC. Second, by the gross gifted donation and by the gross personal pension contribution, basic and higher rate band will increase. Third, uh, adjusted net income reduces by the gross gifted donation and gross personal pension contribution. Okay. Now there's a question. The question is, let's say Mr. Y is having, just a minute, just a minute. Mr. Y is having employment income 125140. That is scenario number A. Scenario number 2, Mr. Y is having employment income of 1 lakh. Required is effective tax rate on 25140. You are required to calculate effective tax rate on 25140. So I'm giving you around 3 to 4 minutes. Please, I want every one of you to attempt this. How much effective tax rate relates to this 25140? You can say this on, let's say, if I just write more, little bit more. Let's say Mr. Y earns 1 lakh employment income. If he gets 125140, then how much tax will be paid on additional income? So logically, I want to know how much this individual will be paying tax only on that additional income, which is 25140. So now I think you have 5 minutes. So kindly, I want every one of you to attempt this. Okay, students, I think let's do it together. Let's say in case A, now let's say Mr. Y is having employment income of 1,25,140. Employment income is a non-saving income 125140. We have no other information. It means that, can I say his personal allowance is going to be 0? Whoever is having adjusted net income equal to greater than 125140, personal allowance becomes 0. So personal allowance is 0. Entire 125140 is a taxable income. Okay, fine. 37,700. Let's take 20% of this. I think 7540. Let's see. So 125140 minus 37,700. How much falls in higher rate band? It is 7,440. Applicable rate is 40%. 34,976. 42,516. This is the income tax liability. Okay. And when Mr. Y was getting employment income only 100,000. So what is the income tax liability when he's exactly getting 1 lakh? can I say when Mr. Y earns exactly 1 lakh, then entire personal allowance 12,570 is available. Here comes the taxable income. 100,000 minus 12,570. I'm getting 87,430. So 37,700 into 20% will get 7,540. Total taxable income is 87,430. Let's deduct the basic rate band. So remaining falls in higher rate band. 87,430 minus 37,700. The difference we are getting is 49,730. Applicable rate is 40%. 19,892. Here comes the income tax liability. I'm getting 27,432. Now, student, try to understand. If he's earning 1,25,140, how much income tax liability he will have to pay? He will be paying 42,516. But if he earns only 1 lakh, then his income tax liability will be 27,432. So additional earnings are 25,140. Just due to this additional earnings, how much additional tax this individual will be paying? 42,516 minus 27,432. So this individual is actually paying 15,084 additional tax because of this additional earnings. So here comes the effective rate. Effective tax rate. 15,084 divided by 25,140 into 100. Let's see what are we getting. We are getting exactly 60%. So always remember the effective rate on that additional earning is actually 60%. Okay. Now students come here. Another concept relating to transferable amount of personal allowance or marriage allowance. Actually, what is the concept of marriage allowance? Let me give you quickly. First of all, marriage allowance in case of husband and wife. Marriage allowance which is 1260. Try to understand. Marriage allowance is only possible when husband and wife both are basic rate taxpayer, the condition number one. Repeat. In order to claim marriage allowance, both husband and wife both must be basic rate tax payer. And the second point, when one of them is unable to utilize his or her entire personal allowance, so that spouse could transfer 1260 to another spouse, but you will have to exactly transfer 1260. Another point, recipient spouse personal allowance will not increase by 1260. Then what to do with this 1260? It's very simple. This 1260 will reduce the income tax liability of recipient spouse. How it will reduce, I'll tell you, but let me repeat the concept. Point number one, husband and wife both must be basic rate taxpayer. Second, one of them is unable to utilize his or her entire personal allowance, then that spouse could transfer 1260, 10% of his personal allowance to another spouse. But exactly 1260 you have to transfer, not less than that, not more than that. How it works, for example, assuming, let's say we have got Mr. A. Mr. A is having, assuming employment income, let's assume he's having employment income of 25,000. So obviously he's a basic rate taxpayer. Let's say Mrs. A, his wife, is having employment income of 9,000. So we know that his wife is having just 9,000 employment income. So his wife is unable to utilize her personal allowance entirely. So what is the tax planning? The tax planning is Mr. A wife should transfer 1260 of her personal allowance to Mr. A. But how that marriage allowance will work, let's see. We are required to calculate income tax liability for Mr. A, considering that tax planning. Look at this. Personal allowance, I'll deduct 12570. 25,000 minus 12570. I'm getting 12,430. Of course, the entire taxable income 12,430, applicable rate is 20%. I'm getting 2,486. Now from this 2,486, student, we will just deduct marriage allowance. And that is going to be 1260 and take 20% of this, which is, I believe, 252. I'm getting 2234. This is going to be the income tax liability of Mr. A. So recipient spouse personal allowance will not increase by 1260. Only first you have to calculate the recipient spouse income tax liability, and from that income tax liability, you will just deduct this marriage allowance. Okay, come back. Donation under payroll deduction scheme. If your examiner says Mr. Y who is working for ABC company and contributes in payroll deduction scheme, so whatever he pays, that will be deducted from the employment income, and that will not increase the bands. If someone is making contribution in payroll deduction scheme, that will reduce the employment income of that individual, and such contribution will not increase the band. Okay, we have a question. Let's see. A long marriage allowance, election spouse. Now, student, listen to me. When there is, of course, we have got husband and wife. So there are number of tax planning opportunities which are possible. Right now, I have just discussed one thing, and that is transferring the personal allowance. Okay. Now, for example, husband and wife, assuming wife is a basic rate taxpayer, husband is an additional rate taxpayer. Obviously, now marriage allowance cannot apply here, but husband who is an additional rate taxpayer. Okay, let's say husband is having dividend income of 20,000 pound, 30,000 pound. We can advise the husband that you can do one thing. Let's say you can transfer 50% of the, let's say, shares to your wife. If not, even you can transfer all of your shares to your wife. In this way, the benefit would be you people are going to save income tax liability. So number of tax plannings are available in case of husband and wife. Is that clear? Is that clear? So in case of husband and wife, there are a number of tax planning which are possible. But right now we have discussed only one. Kindly do not use anything on the Zoom. That's my request. Okay, now come here, students. Taxation of spouse's family. Normally, income received or jointly owned asset will be taxable on both partners on equal basis. That is 50-50. However, election is available for actual proportion of income to be assessed on each partner by declaration to HMRC. Normally, whenever there is a jointly owned asset, in case of course, husband and wife, whatever income is coming from that asset, it will be split 50-50% if nothing is mentioned. But if the couple wants that income should be split according to their actual ownership, then it is possible. But for that, you have to make a joint election. For example, there's a property which they have given on rent, and that property is a jointly owned property. So whatever the rent is coming from that property, it will be split 50-50%, unless you make a joint election, and then whatever the income comes, it will be split according to your actual ownership. Children, all children are taxable person and required to pay income tax if their income is above personal allowance. Pension. Now, this is very important. Come here. Pension, pension, pension. Pension, pension. Just a minute. Okay, students, pension. There are two types of pension schemes in your syllabus. One is occupational pension. Occupational pension means, for example, Mr. Y is working in ABC company and ABC company is running the pension scheme. If your employer is running the pension scheme and you are also a member of that pension scheme, such a pension scheme is considered as an occupational pension scheme. Obviously, every individual is not going to be the employee. There are people that are doing their own businesses, but they also need, I would say, income when they reach on their retirement age. So for those individuals, there are pension policies and they go for personal pension. So there are two types of pension in your syllabus. One is occupational pension scheme, another is personal pension. Personal pension is simply you are taking an insurance policy so that when your retirement age comes, you should not be facing any cash flow problems. The rest of the problem, obviously, someone is going to face. If that person was not looking after his or her health, then obviously on retirement age, you have to spend money on your health. But personal pension scheme is taken like an insurance policy. Now listen to me carefully. If your employer is contributing for you in occupational pension plan or personal pension plan, in any of the plans, if employer is contributing for you, then such a contribution is an exempt benefit for that employee. So if your employer is contributing on your behalf in occupational pension plan or let's say personal pension, there's a possibility that employer does not have an occupational pension plan, but your employer is very nice towards you. Employer says, don't worry at all, I will contribute in personal pension plan for you. So either the employer is contributing in any one of the scheme, or if your employer is out of this world and your employer says, no, I will contribute for you in occupational pension plan and I will also contribute in personal pension plan for you. Wow, great employer, I would say. Then of course both are exempt. So whenever employer is contributing either in occupational pension plan or in personal, or if your employer is out of this world and he wants to contribute in both of the schemes, for an employee, it is an exempt benefit. Okay, now let's say Mr. Y, who is an employee, now listen to me carefully. If an employee contributes in occupational pension plan, if an employee contributes in an occupational pension plan, such a contribution will reduce Mr. Y's employment income. Repeat, when an employee contributes in occupational pension plan, such a contribution reduces employment income for that individual. Okay, when it comes to personal pension, we have just discussed. First of all, student, when an individual, let's say Mr. Y, he has contributed in personal pension plan, listen to me carefully. Contribution in personal pension plan is not an expense of Mr. Y. Contribution in personal pension plan is not an expense of Mr. Y. Such a contribution will not reduce the taxable income for Mr. Y. Then how does Mr. Y is going to get the benefit? Let me explain those benefits which Mr. Y is going to get in case of when Mr. Y contributes in personal pension. Number one, whatever amount Mr. Y contributes in personal pension, it is treated as 80%. 20% will be paid by HMRC. Second, your basic and high rate band will increase by gross PPC. Third, your adjusted net income will reduce by gross PPC. These are the benefits which Mr. Y is going to get if Mr. Y contributes in personal pension plan. Now, there's another very important concept, and the name of that concept is how much Mr. Y for himself plus his employer, they can contribute in one tax year. We know that we are working for 25-26. According to HMRC, the annual allowance limit for the pension is £60,000. Annual allowance limit for the pension is 60,000 pound. Now, what is the importance of this 60? Try to understand the importance. If the total contribution of Mr. Y plus his employer, who has contributed for Mr. Y. Repeat, if the total contribution of Mr. Y plus his employer contribution, either your employer has contributed in occupational pension plan for you, or your employer has contributed in personal pension plan for you, or let's say when it comes to Mr. Y, let's say Mr. Y has contributed in occupational pension plan, plus there is a gross PPC by Mr. Y. All the contribution of employee and his employer will be deducted from this 60,000. Now there are two possibilities. One, assuming we have deducted all the contributions and we still have, let's say, unused 20,000. One possibility that total contribution of Mr. Y and his employer total contribution is not exceeding 60,000. Assuming we have 20, I'm assuming this is unused limit is 20,000. Now listen, unused limit is carried forward for 3 tax years. Unused annual allowance limit is carried forward for 3 tax years. Unused annual allowance limit is carried forward for 3 tax years and it is utilized on FIFO basis. Repeat, we carry forward this for 3 tax years and utilized on FIFO basis. Now another possibility, annual allowance limit is 60. What if the total contribution is 80,000? I'm just assuming. Let's say Mr. Y does not have any previous unused annual allowance limit. So obviously, if you do not have any previous unused annual allowance limit, in the current year, you have just 60. But the total contribution by Mr. Y and his employer is 80. So how much additional Mr. Y has total, how much additional contribution is made? 20,000. Now what to do with this 20? Now listen, if the total contribution is more than 60,000, that additional contribution is treated as annual. This is called annual allowance charge. Now listen to me carefully. This annual allowance charge is technically treated as other income. And on this other income, you will have to pay tax. And tax rates, they are applicable. Those tax rates, they will be coming from the non-saving income. Repeat, if the total contribution exceeds 60, if the total contribution exceeds 60, that additional, the amount which is over and above 60,000, that amount is called annual allowance charge. Number one, it is treated as other income. On this other income, individual will have to pay tax, and applicable tax rate, they are coming from the non-saving income. Okay. But story does not end here. Now there's one more thing. There is a possibility that, let's say, we have Mr. Y, and Mr. Y is not an only employee. Assuming he's a very rich person. Assuming that just the salary of Mr. Y is 300,000 pounds. Wow. And he has got, let's say, property income as well. Okay. But he will still be getting the benefit from all these pension schemes. Then HMRC says, no, this is not the case. Those people, they are, let's say, very rich. They have got deep pockets. They are extraordinary wealthy people. They will not be getting the benefit. They won't get the exact benefit from these schemes. How? Now listen. There is one income, and name of that income is threshold income. If the threshold income is more than 200,000, first point, threshold income is more than 200,000 and adjusted income. Adjusted income is more than 260. Both the conditions must be met. If both the conditions are met, threshold income is more than 200,000, adjusted income is more than 260. For that individual, annual allowance limit, which is 60,000, that will start reducing. Repeat. If the adjusted income is more than 260 and threshold income is more than 200,000, then annual allowance limit of 60,000 will reduce. For example, we'll see the format, don't worry at all. We know that annual allowance is 60,000. I'm assuming this Mr. Y, how do we calculate adjusted income? I'll come to this. Let's say Mr. Y is having adjusted income 300,000. If he's having adjusted income 300,000, so he will not get the annual allowance 60. What we'll be doing? We'll take 300,000 minus 260. I'll take 50% of this, 20,000. So instead of 60, now for Mr. Y, annual allowance limit will be 40. Now, what is the importance of this 40? Let me tell you the importance of this 40,000. Now, if the total contribution of Mr. Y and his employer is more than 40, then that additional contribution is treated as annual allowance charge, and that annual allowance charge is your other income and you have to pay income tax. If the total contribution is less than 40, then there will be an unused annual allowance limit which will be carried forward for 3 tax years. So this is the importance of this 40,000. Now the total contribution will not be compared with 60,000, it will be compared with 40,000. But student, listen to me carefully. Assuming that Mr. Y is having adjusted income, let's say 400,000. Wow. Adjusted income is 400. Great. Into this. Now listen to me carefully. Student, adjusted income is 4 lakh. 4 lakh minus 260, difference is 140. If I take 50% of 140, it will become 70,000. But instead of 70, I'm writing 50. You might be thinking, sir, that's a mathematical error. Because those students, they love maths, they will be saying, sir, 4 lakh minus 260 is 140 and 50% of 140 is 70,000. But your teacher is writing 50. Can anyone tell us why I'm writing 50? Why I'm not writing 70? Why I'm not writing 60? Students, what is the reason that why I've written 50? Any reason? Even though mathematically we know that 70 is coming, but still I'm writing 50. Why? Let's see why. Yes, the minimum annual allowance limit is 10,000. Annual allowance cannot become zero. Annual allowance cannot become zero. Annual allowance, the personal allowance can become zero. But when it comes to annual allowance, students, your annual allowance cannot become zero. The minimum annual allowance is going to be 10,000. It could not be less than 10. Now, kindly come here. Just a minute. Actually, before 23-24, the annual allowance limit used to be 40,000, but now it is 60. Okay. Threshold income, total income less individual gross personal pension contribution. How do we calculate adjusted income? Total net income plus individual occupational pension contribution plus any employer contribution to either occupational or personal pension scheme. Look at the format, students. How do we calculate adjusted income? Total net income plus we are adding the individual occupational pension contribution plus if your employer has contributed either in occupational pension plan for you or your employer has contributed in personal pension plan for you, we will add both of them while calculating adjusted income. So I hope that format of adjusted income is clear to everyone. Kindly reply. Students, kindly reply on this. I believe that is not an issue at all. Okay. Let me just write one example for you and let me just pause the video. Now let me read this entire example for you. and then I'm going to give you at least 15 minutes, okay? But I want everyone to attempt this. Mr. Y annual salary is 2,04,000. Accommodation benefit, I'm directly giving you 5,735. Gross personal pension contribution by Mr. Y is 120 in the current tax year. His employer contributes 4,000 in every year, okay? Every year means every year, okay? Gross PPC by Mr. Y in the tax year 23-24 was 49,000. Gross PPC by Mr. Y in the previous tax year was 24-25, which is 58,000. We do not have any other information. And we are required to calculate income tax liability. And let me write one more thing for you. Mr. Y joined his employer on 6 April 2023. So Mr. Y joined his employer on 6 April 2023 and also joined occupational pension scheme because his employer is contributing for him. So we do not have any other information. This is the only information which we have. So students, please, now I want every one of you to solve. I'm reading the data again. Mr. Y annual salary is 204, accommodation benefit 5730, gross PPC is 120 in the tax year 25-26. His employer contributes 4,000 every year. Gross PPC by Mr. Y in the tax year 23-24 is this 49. We do not have any information for the previous year. It means, now listen to me, if I do not have any information before 23-24 what Mr. Y was doing, I don't have any information. It means I will assume that in the previous tax year Mr. Y was not a member of these registered pension scheme, because all these rules that someone has contributed more than 60 or less than 60, they are only applicable when you become a member of a registered pension scheme. And registered pension schemes are two in our syllabus. One is occupational pension scheme, and another is personal pension. You have to be a member of any one of them. It means after that all the rules are applicable. So if we do not have any information of the previous year, it means 23-24 is the first year when he started contributing in personal pension plan. Okay, Mr. Y also joined his employer on this date, and he also joined the occupational pension scheme as well. And now examiner is asking, give us the income tax liability for the tax year 25-26. Let me little bit zoom out. I think now it is readable. I'm giving around 15 minutes to every one of you. Let's see who will answer this. You have 15 minutes. Please attempt this. Okay, students, let's start. Annual salary is 2,04,000. Accommodation benefit is 5,735. We are required to calculate income tax liability. And we are working for the tax year 25, 26. Salary 204. Accommodation benefit is 5,735. Accommodation benefit 5,735. Here comes the net income. 204 plus 5,735. 2 lakh 9,735. Net income. Now we have to check How much personal allowance this individual will get? Let's say working one. We need to calculate ANI, adjusted net income. Net income, we know that it is 2 lakh 9735 less gross personal pension contribution, gross PPC. In the current tax year, gross PPC is 120. Wow, wow. Let's see. I'm getting students 89,735. Can I say ANI? Logically, it is 89,735. ANI is less than 1 lakh. Whoever is having adjusted net income either 1 lakh or less than that gets entire personal allowance, which is 12,570. So here comes the taxable income. 209,735 minus 12570. 1,97,165. Okay. Basic rate band is 37,700. It will increase by gross PPC, which is 120 in the current tax year. Higher rate band 125,140. It will also increase by gross PPC. So here comes the revised, you can say, limits. 37,700 plus 1,20,000. 1,57,700. 125,140 plus 120. 2,45,140. Okay. Income tax. Can I say now the basic rate band limit is no more 37,700. It is actually 157. I'll give the reference of working to 157,700. Applicable rate is going to be 20%. 1,57,700. Let's take 20% of this. Students, I'm getting 31,540. I'm getting 31,540. Okay. So the taxable income is 1,97,165. Can I say from 197,165, if I deduct 157,700, difference will fall in higher rate band. What is the difference? 197,165 minus 157,700. Students, I'm getting 39,465. I have deducted 157,700 from this. So in higher rate band, I'm getting 39,465. Let's take 40% on this. I'm getting 15,786. Story does not end here. Why? We have to see other areas as well. Because if you look at his net income, his net income is 209,735. Okay, we have seen ANI. ANI is less than 1 lakh, so the entire personal allowance is available. But how much he wants to contribute in the current year? That is going to create the problem. In the current year, Mr. Y wants to contribute 120. Story does not end here. His employer contributes 4,000 in every year. So we have to see either the contribution is more than the 60,000, more than the available limit. If total contribution is more than the available limit, so we have already discussed one thing. It is considered as annual allowance charge. Annual allowance charge is your other income and you have to pay income tax on that. But we have got the information from the tax year 23-24 onwards. So what happened in 23-24? Mr. Y gross contribution is 49,000 and his employer contributes 4,000 every year. And don't forget, student, tax year 23-24 is the year in which he joined the pension schemes as well as his employer. So look at this, another working. I'll say working 3. Okay. Tax year 2023-24. Tax year 2023-24, annual allowance limit is 60,000. Gross PPC by Mr. Y, 49 if I'm not wrong. Employer's contribution is 4,000. How much is unused? Let me take the calculator. 60,000 minus 49 minus 4. Logically, 7,000 is unused. Of course, this unused annual allowance carry forward. For how many years? Can I say for 3 tax years? For how many years? For 3 tax years. Okay. Now let's go for the next tax year. 2024-25. First of all, we'll take the normal limit of 24-25. Can I say the normal limit of 24-25 is 60,000? Keep watching, students. Now, please listen. The 7,000, which is unused, it is carried forward for 3 tax years. I will add unused, brought forward annual allowance, which is 7,000. So logically, in the tax year 24-25, we do have 60,000 plus we also have a brought forward 7,000. Okay. I got 67. Gross PPC by Mr. Y. How much he has contributed? He has contributed 58 and his employer has contributed 4,000. He has contributed 58. Employer contribution is 4,000. Okay, we still have unused, and that will be carry forward. How much we still have unused? And then I'll tell you something very logical also. Student, we still have 5,000 unused, which will be carried forward. Now, listen to me carefully. Listen, if you want to be more logical, more technical, then there is one question and try to understand that, please. The question is, sir, in the tax year 24-25, we have got 2 things. Please try to understand. I want to say something which is very important. I want you to focus on this. In the current tax year, we have the normal annual allowance limit of 60,000, which belongs to the current tax year 24-25, and we do have brought forward annual allowance 7,000 also. But there is a question. The question is, whatever in the current tax year in 24-25, Mr. Y has contributed and his employer has contributed. If we want to be more precise, so the contribution of Mr. Y and the contribution of his employer will utilize logically which limit first? Will it utilize 60,000 first or 7? Because right now what I did, I've taken 65. So in 65 we deducted 58, we deducted 4,000 as well. But there's a question. If a student says, sir, let's talk little bit more technical, that because the student is thinking that in the current tax year, let's say in 24-25 we have got two things. One is the annual allowance of the current year, and we have got the brought forward as well. So if you want to be more technical, now listen the answer logically. First, we will utilize the normal annual allowance limit of 60,000 in the tax year 24-25. So logically in the tax year 24-25, annual allowance limit is 60. I will use this. Now listen, gross PPC by Mr. Y is 58. Okay. Now, employer contribution. Employer contribution is 4. So obviously we don't have that much space. So how much additional here the contribution is coming if I compare with 60? Can I say 2,000? So logically that 2,000 will consume your brought forward limit. Logically that 2,000 will utilize your brought forward limit, which means that if someone wants to be, I would say, extraordinary technical, then that student can do one thing. You deduct 2,000 from here. Now, brought forward 7, and employer's contribution how much? 2. So 5 will be carried forward. The same 5, but I've just answered one thing. If someone is thinking, sir, that in the current, let's say in the tax year 24-25, which one will be utilized first? So I have answered that. Logically, you will be utilizing the 60,000 first. After that, you will be using the brought forward unused limit. So I have answered that. Okay. Now we still have 5,000, and that 5,000 will carry forward. Now the main year comes, for which we are actually solving the question, which is tax year 25-26. Now listen, the annual allowance of tax year 25-26 is 60,000. And let's say we do have brought forward. How much? 5. Now listen to me carefully. Logically, annual allowance limit is available annual allowance limit to Mr. Y is 65. But how much Mr. Y has contributed? Can I say his gross contribution is 1,20,000, and his employer has contributed 4,000. Try to understand. Gross PPC by Mr. Y is 120. His employer contributes every year 4,000. Employer contribution is 4. So actually the total contribution is far more than the available annual allowance limit. Annual allowance available. Available is 65. So can I say they have the total contribution is more than the available annual allowance limit? When your total contribution is more than the available annual allowance limit, it is called an annual allowance charge. On that annual allowance charge, you have to pay income tax. Students, I am getting 59,000. And this 59,000 is your annual allowance charge. We will treat like an other income. And on this other income, you have to pay income tax. And then tax rates applicable, they are coming from the non-saving income. So it is other income, non-saving income. Now come here, please. So on this 59,000, we have to apply the income tax rates. Working 3. Now, before applying any income tax rate on 59,000, you have to see how much space we have in the basic rate band or in the high rate band. Apologies, my bad. Higher rate band limit is now 245,140. How much we have utilized? We have utilized 197,165. We have utilized 197,165. Let's see, just a minute. 245,140 minus 197,165. Student, we still have a space in higher rate band 47,975. Logically, on this 47,975, we'll apply 40%. 47,000 9, let me do this. Logically, it is annual allowance charge. 47,975. We'll apply 40% on this. I'm getting 19,190. Now the remaining annual allowance charge actually falls in additional rate band. And additional rate band applicable tax rate is going to be 45%. Annual allowance charge we have calculated 59 out of 59, 47,975 actually we have taken in higher rate band. So the remaining actually falls in additional rate band. 59,000 minus 47975. I'm getting 11,025. So let's say if you want, you can say this is working for, it's up to you. Annual allowance charge. Logically, 1125 falls in additional rate band. Just a minute. Additional rate band. Sure, so I'm getting 4,961.25. So let's take only 4,961. Let's add all of them. This is going to be your income tax liability. 31,540 plus 15,786 plus 19,190 plus 4,961. Students, I'm getting income tax liability 71,477. And majority did not give the answer, and those they have given the answer, it was absolutely wrong, I would say. It was nowhere near to 71,477. So income tax liability is students 71,477. And this is just the income tax liability calculation on which I would say almost 100% of the taxation student, they feel that we have a very good command. But sometimes what happens that overconfidence can create the problem. Now, student, listen the instructions carefully, how we are going to take our crash from here onwards. We will be having a class tomorrow as well. Every day, I'm going to announce the class timings in our Sir employer contribute. No, 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 no. Students, listen to me carefully. If employer contributes either in occupational pension, let's say employer is contributing in occupational pension plan. Okay. So that will remain the same amount, whatever he has contributed. Second, assuming employer has contributed in personal pension plan for the employee. Such a contribution, you are not supposed to gross it up. The gross up option is only available when we are working. Let's say here we are working for Mr. Y. When Mr. Y is contributing for himself, then I will gross it up. When my employer is contributing in personal pension plan for me, I will not gross it up. Is that clear now? So this gross up option is only available when, for example, I'm solving the income tax liability question for Mr. A, and Mr. A has contributed in personal pension plan for himself. Only then we are going to gross it up. If my employer is contributing for me in personal pension plan, I will not gross it up. Plus, when my employer contributes, one, I'm not going to gross it up. Second, it will not increase my basic and higher rate band. Third, we know that when my employer is contributing for us, either in occupational pension plan or a personal pension plan, for me, it is an exempt benefit. I hope all the tax implications are clear to everyone. Is that clear now? Okay, students, now listen, we'll be having a class tomorrow, inshallah, on the same timings. Number one. Number two, every day I'm going to announce the class timings. Yes, If your employer make it very simple. When my employer contributes for me, it is an exempt benefit, number one. And number two, I will never gross it up. When someone is contributing for me, we never gross. Is that clear? When someone is contributing for me, it will never be grossed up. Okay. So students, we have a class tomorrow as well, and we'll start from here onwards. I will try to cover the entire taxation course. Entire means entire, inshallah. Uh, Plus, we'll be having a class more or less on, I would say, every day. Same timings. Okay. Same timing is going to be same, number one. And plus, today's class recording will be uploaded on the, of course, portal, as well as it will be uploaded on the YouTube channel of Abeel School of Accountancy. But only the first class will be uploaded on the YouTube. Class number 2 onwards will only be uploaded on the portal. So only those students, they are enrolled with us, they will be able to get the benefit from, I would say, recorded classes. So that is why I would say those they really want to have the crash course, do not miss the class, because if you miss and if you are unenrolled, then you will not be able to get the recording. So plus one more thing, just one announcement, then we are going to end the class. In all ACCA papers, we have got our crash courses. All means all. There is one crash course which is already available on the portal. Just within, by spending 5 to 6 hours, you can revise the entire taxation. PM crash course is also available. By spending 5 to 6 hours, you can revise PM. Same 6 to 7 hours crash course is available for FM, FR. When it comes to SBR, there are two types of crash courses. One crash course is 7 to 8 hours in which I have revised all the ISS and IFRSs. And there is one 7 hours consolidation crash course also available in SBR. ATX crash course is only 11 hours long. By spending 11 hours, a student can revise entire ATX. AFM crash course is around 17 hours long. By spending 17 hours, you can revise entire AFM. So that is all about today's first, I would say, crash course class of taxation. Finance Act is 2025. So do give the feedback in your relevant WhatsApp groups. Thank you very, very much. Thanks a lot.